If you have a business and you process payroll in your business, then you must watch this video because very often than not, a lot of business owners underreport or not properly report payroll tax expenses, meaning so when you pay your employees, you incur a payroll tax. How that gets reported on your taxes may be costing you a lot of deductions. On top of that, a lot of business owners don't properly report owner compensation on their tax return. So in this video, I'm going to show you exactly how to maximize your payroll tax deduction and at the same time, stay in compliance with your owner compensation in your business. Ready? Let's go. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. Awesome, let's get started over here. First of all, before we continue about payroll tax deduction strategy, let's really understand what is a payroll tax. Okay, a payroll tax, it's basically a cost. It's an expense to you, the business owner, every time you process payroll. So the government says, hire employees, pay them salaries, but on top of that, you're going to pay payroll tax. So you as an employer, you're probably already familiar that you pay what's called a Social Security tax and a Medicare tax. So altogether, this makes up 7.65%. On top of that, another most common payroll tax is a state unemployment insurance tax. This is basically state is taxing you. Okay, state is taxing you on the fact that if the employee claims unemployment insurance, the state will pay them unemployment benefits. This tax ranges anywhere from 1% and up. It usually has a limit depending what state you're in. I think in New York State, we're like at $14,000 limit. But overall, I like to calculate a 10% total payroll tax because there's some other costs that you incur when you run payroll, and that is your payroll expense. So your total cost as an owner is 10%. That means, think of it this way. For every $100 that you pay to your employees, you incur a cost of $10. That's costing you, the business owner, on top of the salary that you pay to your business. So that is really a payroll tax. And when you report your taxes, or when your tax preparer is doing your taxes, and listen, by the way, if you're working with a tax preparer, somebody who's putting the right numbers in the right boxes, I can guarantee you right now, you're overpaying in taxes. What you need is a tax advisor, because only with a tax advisor, you'll be able to strategize what we're about to strategize for you. So right now, I want you to understand what is a payroll tax. Payroll tax is about 10% of what you pay your employees. On top of that, in most cases, you as an owner, even when you draw a salary from the business, you also pay a payroll tax. So government says, hey, we don't care that you own the business. If you pay yourself a salary, you still have to pay the employer's portion of Social Security and Medicare tax. Now, what is really a problem with the payroll tax for most business owners? For most business owners is how they report their payroll taxes on payroll tax expense, on their tax return when they file it. What happens most often than not, a lot of business owners, they think they're saving money on taxes by hiring a bookkeeper that's charging $65 a month or $100 a month or $150 a month. You have to understand that bookkeeper cannot survive on a salary of $150 a month. So what happens is that they end up having a lot of clients. And when they end up having a lot of clients, when you process payroll in your business, when it comes into your profit and loss, the bookkeeper doesn't sit there and distinguish between salary, payroll expense, and officer compensation. And everything that comes out of your account on your bookkeeping, assuming you use some kind of a bookkeeping software, gets dumped into either a net payroll, clearing account, or payroll expense. At the end of the year, if you're lucky, your accountant, preparer, or bookkeeper will make some adjustments. But in most cases, those adjustments are not correct. It's just a lump sum because they need to move it forward. So what happens is that on your profit and loss, you'll see something net payroll, clearing account, or payroll expense throughout the year. Everything just being dumped here. At the end of the year, they may make adjustments to put, to basically say salaries and wages and payroll expenses. But what's going to happen is that it doesn't always match the W-3, which we're going to talk about. We have a little, let me just fix that to a W-3. And I've seen many times when I received tax returns from business owners and I reviewed their payroll expenses, very often it didn't match the payroll report that was run by the payroll company. Every time when I put two and two together, it's missing, right? The payroll report says, hey, they paid, let's say, $100,000 in payroll, wages, salaries, and payroll taxes, but on the tax return, I see a lower number. And the lower number is really the fact that at the end of the year, they try to reconcile it very quickly. They don't know where to stick it, and they stick it into what's called a payroll liability, which goes on a balance sheet. So you as a business owner, you might be thinking, well, Boris, why do I need to know this? Aren't the people that I pay to be a professional and to help me should know this stuff? You are correct, but it depends who you're working with. Are you working with a bookkeeper or tax preparer who putting the right numbers in the right boxes, or are you working with a tax advisor to be able to analyze these things? And I see this problem very often. What I see most often, actually even worse, is that all the payroll expenses get put on a salaries and wages on the business tax return, and officer compensation line 7 of an S corporation is blank, and the officer paid himself or herself a salary. And if this line is blank, if it's missing a number which should be here, it triggers an audit, because IRS looks for to see if the owner of the business, or especially an S corporation, pays themselves a reasonable compensation. And they do in fact pay themselves a reasonable compensation. What they don't do, what doesn't happen on their taxes, it doesn't get reported properly on the officer compensation. Instead, it gets reported on salaries and wages on the business tax return. Everything gets dumped there. And even salaries and wages in most cases are not correct. What I encourage you, the business owner, is not only have somebody who knows what they're doing when it comes to this, but really when you have your quarterly meetings with your tax advisor, always review your profit and loss with them. Always review salaries and wages and be like, hey, how's my salaries and wages? Are we capturing everything there? Are we taking account into the fact that I have an officer compensation, I pay myself a salary? Now, in the next segment, we're really going to talk about the tax strategy to make sure that you're actually maximizing your deduction and staying in compliance. We'll be right back after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself. Or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. All right, cool. Welcome back. Now let's talk about a tax strategy for taking a payroll tax deduction. First and foremost, when you're doing your taxes as a business owner, you always want to make sure you provide your accountant or whoever's doing your taxes with what's called a payroll report from your payroll company. And from that payroll report, they're going to extract salaries and wages. And there's also going to be something that's called a W-3. When you take a look at your tax return, your salaries and wages plus the officer compensation must match what's reported on a W-3. W-3 basically a governmental form copy that you let the government know, the IRS know, hey, this is the total payroll cost of all the W-2s that is being reported, and your salaries and wages would match that. The most important thing here is to make sure that the officer compensation line 7 of an S corporation or even on a C corporation is listed. There is a number there. If you don't have a number, it may trigger an audit. At the same time, take a look on your payroll liabilities. Question your accountant, your bookkeeper, whoever's working with you. Hey, I see payroll liabilities on my balance sheet. Why is there a number, and why is this number high? Now, true, before the year is over, then there should be a number there. In most cases there is, but a decent number for your payroll taxes, right? So if you ran $100,000 payroll right before December 31st, your payroll tax liability should be about at least $10,000 plus what you withheld from employees. So you should already know that what number should be there. But when you see a really big number, that most likely your accountant is really using it as a plug number, right? To plug it in, and you, the business owner, as a result, really overpaying or really missing out on a deduction, which causes you to overpay in taxes because salaries and wages and officer compensation was not reported properly. Now, I always say this in all the social media content that I put out, and when I speak to business owners, if you have a tax preparer, then you do not have a tax planner or a tax strategist. If you want to pay less in taxes, what you need is a tax advisor. You got to work with a tax advisor. And the first step with working with a tax advisor is reviewing your prior tax returns. In most cases, there will be opportunities found to either amend the tax return or to create opportunity for going forward in the future years to be able to save money on taxes. I hope this video was helpful. Thank you so much. Until the next time.